All right, folks, welcome to Investing for Beginners podcast. Today we have episode 370. Today we're going to answer some great listener questions. And speaking of questions, if you have a burning question you're just dying to know, send it to us at newsletter@einvestingforbeginners.com, or you can send them to us on the Spotify app if you're listening to the show on that app, which I would highly recommend you do. Or you can send them to us via the socials. You can do the old X or Twitter machine thing. So with that, let's go ahead and dive in. So we got the first question is from Ronnie. So something I've noticed on some stocks is the PE or other metrics aren't showing on the Fidelity app. Is that because the company isn't reporting, or is there another possible reason? Also, should that be an immediate flag? Great question. So what are your thoughts on this, Andrew?
Yeah, great question, Ronnie. I would not consider it an immediate flag. There could be, like you said, several reasons. One that I can think of off the top of my head, maybe the company has negative earnings. Maybe they have one bad quarter or one bad year. And so can't have a PE if there's no earnings, because earnings is the E in PE. So that could be a reason. Another reason, it depends on your platform, right? No financial website's perfect, and they all make mistakes. We all make mistakes. Everyone makes mistakes. So I wouldn't consider it necessarily a bad thing. It's nice to have shortcut tools, but as far as like being an obvious red flag, I would not consider it that at all.
No, me either. No, it's, sometimes the reporting is not up to date or up to snuff. I frankly don't use Fidelity is my main brokerage app, and I do use them and I like them, but I honestly have never used it for any sort of fundamental research ever. I don't even know where I would go if I wanted to. That's how little I use it. I prefer to use things like FinChat, BAMSEC, and things of that nature. So for me, it's not really, and I would look to other sources before I would get too excited about what I'm seeing on my brokerage account. And so color me skeptical, but that's, I guess, how I would look at it.
Yeah, in that camp too.
All right. So let's move on to the next question. So this is from the Twitter machine. If you have a lot of listeners at my age, early 30s, many of them were probably immediately enrolled in FNSDX, Fidelity's 2055 target date 401k fund. The expense ratio is 0.65. Can you help us understand if that's considered high for a workplace retirement plan? I like that the rebalancing is done for me as I get older, so maybe that's worth some fee. But I'm worried I'm costing myself a ton of money when I could just leave everything at Fidelity and invest in FSKAX for 0.02% and be super well diversified for a long term and probably better off even without rebalancing. What do you think about that? So great question. And I guess what are your takeaways? What did you learn about this?
This can have a lot of moving pieces. Let's try to keep it simple though. What's good for a ratio kind of is all relative. I know workplace retirement options, they can be all over the map. So really, depending on your employer, you might have a lot of options or you might just have a few options. So what's a good ratio? What's a good expense ratio? That can sometimes be relative, again, just depending on what's available. According to Investopedia, they were talking about what's a good expense ratio for mutual funds. They saw anything between 0.5% or 0.75% as considered a good one. They consider anything above 1.5% considering as that is too high. But again, that's mutual funds. Bogleheads, which is a great subreddit, and they're great for questions like this, by the way. They're experts, very well versed in the whole indexing, the 401k stuff, all of that retirement stuff. That's a great subreddit to go to. I saw there was a thread in there they were asking, is there a 0.65? Is that a high expense ratio? Some people said, no, it's pretty good, not that bad. Somebody else said that's high. You can get something as low as 0.03% from something like a S&P 500 ETF. VOO is the ticker. But again, you have to have that as an option from your employer for your work retirement. And that's not always an option for everybody. So I don't think it's crazy. I mean, the thing that maybe is another thing we could tackle, again, with the context that we're not like super retirement folks, right? But like the whole target date fund. What are your thoughts on that whole thing?
I guess I am not in the camp of target date funds. I know it can be a very triggering conversation. There are strong opinions on both sides of the camp. I guess I'm in the camp of not a fan of them, simply for the fact that you are really kind of turning over your investment portfolio to, a computer or an algorithm to determine when is the best time for you to start changing the allocations. And to back up for a second, a target date fund, what it does is it establishes when your ideal retirement date would be. And as you get closer to that date, it starts adjusting your investments to rebalance them into more conservative types of investments. So, for example, it would take you out of stocks and put you in things like bonds or money market funds. And that part of it, I think, is a good idea. What I'm not a fan of is, let's say you're 42 and you start working at a company, and maybe you're kind of behind the eight ball on starting your retirement savings plan. The target date fund, if you're scheduled to retire in 2060, for example, it's going to automatically look at, okay, you got an 18-year time window, and it's going to automatically put you in a more conservative portfolio out of the gate. And you have really no way to adjust it. It's kind of preset for you. And in and of itself, that's not bad. But if you need to put air quote play catch up, it doesn't give you a lot of flexibility to do that. And the best way to play catch up is to invest in the stock market. So buying stocks. Now, with a target date fund, you can't go buy Google and Microsoft individually if you want, but it can invest in, the S&P 500, and so the idea would be that if you're wanting to air quote, play catch up, you're going to have to put more money in stocks than you are in bonds, because just fundamentally, that's a better way to make more money. You're taking more risk for sure, but you're also putting more money into the market, which is historically shown that's the best way to earn the best returns. And so that, to me, that's one of the things I don't like about a target date fund, is it removes your flexibility based on what your risk profile is, where you are in your retirement plan, and really how you want to invest. And I think if you are starting out at 25, then maybe a target date fund is not so bad, because it's going to be more aggressive earlier on. And that's ideally what you really want, is because you have that longer time horizon, you can be more aggressive and recover from any mistakes, where as you get older, then ideally it moves you to more conservative. But again, if you are kind of behind the game and you need to play catch up, then it doesn't allow you the flexibility you need. And so that, to me, is like the big killer, if you will, of target date funds. And again, I know this is very triggering for some people, so I apologize afterwards if I've caused you to rage drive off the road kind of thing. So
okay. Was it you or was it Andy who had kind of that horror story with the target date fund, that the algorithm made a adjustment when interest?
Andy, yeah, it wasn't me.
Was it Andy? Okay.
Yeah.
I think it was something that happened around the pandemic. But, in these times of crisis where the stock market would drop really, really substantially, I think that's what happened when COVID hit and the stock market crashed for that short period of time. I think he said his target date fund actually sold stocks to buy bonds because the allocations got out of whack, because the target date fund is trying to set particular allocation between stocks and bonds. And it's like, no, we want to hold through the stock market crash because this is our retirement, right? So that's also a risk with the target date funds that when I heard that, I was blown away. I was like, wow, I didn't even know it would do that,
Right.
Algorithms.
Yeah. They can be deadly, right?
Right. Yeah.
So I guess one other thing that I wanted to throw out there, when you're investing in your 401k, they have to, investor relations or the HR department has probably 99.98% of the time, they can't tell you what to invest in, but they do have to provide you with prospectuses, easy for me to say, or investor materials on potential investments. And so this idea that we're talking about expense ratio, those are the fees that they charge you to manage the money that you put in the investment. And they will tell you in very black and white how much they're charging you to manage their money. And so that's something that you can easily find out by looking at these investor prospectuses. So for example, my daughter-in-law, when she got her first job out of college, she enrolled in her 401k, but before she did, they had 3 whole choices. So she sent them to me. And so I looked them up and I was able to tell her what the expense ratios were, what they were investing in and how they were investing. And so then she could make a choice on, what do I want to do? And so those are things that you can and should do before you choose whatever it is you choose. When I worked at Wells Fargo, we had quite the menu to choose from, 15, 20 things, if I remember right. So it was a lot of choices. And I know, like Andrew said, there's some companies you get 2, 3, 4, sometimes 1, so you don't get a lot of choices. So, but to do your air quote due diligence, request those prospectuses or investor materials so you can see what these numbers are. And if you want some good entertainment, go to that subreddit that Andrew was talking about and maybe type in a question about target date funds, and then you can just sit there and eat the popcorn and watch everybody, all the comments fly by.
Yeah, don't tag us in there. I don't know.
No.
That noise.
No. Anonymous source. That's the way to fly. All right. So next question we have is, hi guys, thank you for your good work. I really enjoyed your podcast and it helped me a lot to understand many concepts of trading. I have multiple questions for you. Number 1, I have seen a few good companies' debt to equity ratio, which is high. So it's a red flag, but they have retained earnings more than their debt. As an investor, how to evaluate these companies? For example, Caterpillar. So do you want to unpack this first one?
Yeah, this is a great question. So debt to equity is a great shortcut tool to figuring out if a company has a lot of debt or not. But there is a sliding scale of debt and like what's considered appropriate or not. So another debt metric that's used a lot by investors is net debt to EBITDA. And just to try to translate that into English, it's basically how much debt do you have and how's it compared to the company's ability to make profits or have earnings. And so there are some businesses where the balance sheet maybe isn't as great, but the company is still very, very profitable. And so it's not like a super risky thing. US government maybe be one of those. Just kidding.
Yeah.
So like the riskiness of the debt can depend sometimes on the type of business. Another example I like to think of is like REITs or real estate investment trusts. They tend to have a lot more debt than your regular company like
Caterpillar.
Yeah, even a company like Caterpillar who might have a higher debt to equity. Because if you know how a REIT is structured, they have land and they have contracted rent that's coming in. And yes, some of that will default, but they still have that land, that property, those assets that are serving as collateral. And so the REITs in particular can get a lot cheaper debt, a lot more debt, and it's not necessarily a risky thing because they have the assets to back it up. Mm-hmm. But their debt to equities will be higher and their net debt to EBITDAs will be higher than, Apple or Microsoft or something. So that's something that's kind of in the equation. It's important to look at the debt to equity. It's a great shortcut, but it's not the only tool. So what do you think about that? Do you have thoughts on like the Caterpillar idea also?
Yeah. So I think the way I try to look at it, and this has evolved over years, when I first started investing, debt to equity was a big thing for me. And as I've learned more, I guess I've branched out and use, more of a 3-tier system, if you will, when I'm thinking about the debt. And so the first thing I will look at is a debt to equity ratio. But then I also look at something like the interest coverage ratio. And what that really does is it compares the interest payments. So when we're thinking about debt, the majority of it for companies is actually in bonds. And so what that is that's money that we are giving to the company in form of interest payments as our return. And then the company, Caterpillar, for example, will give me, I'll give them $100 and then they'll pay me $3 a month or $3 every quarter for the privilege of holding my $100. And then they'll take that $100 and use it to reinvest in whatever it is they want to do. So that's kind of how that whole mechanism works. The interest coverage ratio, what that does is it measures that $3 payment that they're making to me compared to the earnings, the operating earnings of Caterpillar. And so the higher that number is, the better it is. It means that they're generating more than enough income to cover their interest payments. One of the biggest routes to bankruptcy is through interest coverage, not being able to make their debt payments. And when the interest coverage ratio gets below 1.5 is kind of the red line. So if it starts to get below that, that's scary territory, because then you see that they're taking on more debt than they can afford to pay back. So think about us in our personal lives. If you take out, if you buy a car and you take out a loan that you can barely afford to make the car payment, and then something goes awry in your personal life, then you're putting at risk, defaulting on that loan and them taking the car back. And it's the same thing, same concept with the business. So interest coverage ratio is very important. And then the last thing I'll look at is the structuring of the debt. When is the debt due? So you may see this really big number, but if it's spread out over a long period of time, then the company, if it's generating enough cash flow, should be able to easily pay that off. And so to using something like the net debt to EBITDA, you can literally swap that out for a different acronym. You can do net debt to free cash flow. You can do net debt to EBIT. I mean, whatever it is you want. But the bottom line is you're looking to see how the debt is structured. So let's say that, just for an example, let's say that they owe $1,000, but it's broken up in $1,000 every 8 or 9 months. Then that makes it, or $100, I'm sorry, I can't do math. So if you do it at $100 every month, then it makes it a lot easier for the company to pay that $100 off and make the interest payments and not put themselves in jeopardy. So even though the debt to equity ratio may be high, let's say it's 2.5 or something, and you're like, that's not great. But as you dig in a little deeper into those other metrics, then you can go, okay, well, it's a little high, but based on their operating performance and their ability to make their, payments, I think it's not as big a deal as it may look like. So that's kind of how I try to approach it.
Yeah. Those are all great ways to do it.
All right. So let's move on to the second part of the question. So calculation of a DCF, or discounted cash flow, will include the debt as well or not. Sometimes debt plays a huge role in this. Thank you so much. So when you think about a DCF, again, a discounted cash flow model, how does debt impact that or not?
Yeah, this can be a little tricky, right? If you're not well versed in DCF or discounted cash flow, I'd probably, put earmuffs on and just wait until we get to a more easier topic, because this might just start to make your head spin. But for a free cash flow to equity model, you're looking at the equity value of the entire business. There's an entire business, right? You have the firm, and then you have the equity, which is the shareholders, the people who own stock in the company. That's the part that we all like to focus on because we're stock pickers, right? When people use the word stakeholders, they say we have stakeholders, we have customers, employees, and then you have the shareholders, but then there's also the bondholders. And to all this discussion around debt and Dave's example about what a bond is, you think of that as the firm, equity and bondholders is the firm. And then the equity side is just the stockholders. So a free cash flow to equity, which is just looking at the shareholders, that one is not looking at debt per se. So the interest expense will still affect your free cash flows because that needs to come out. So it is part of the cash flow statement. So it does play some part of an impact. And I'm just talking about the interest expense itself. But the amount of the total debt is not making an impact to this type of valuation model. And so if you're using a free cash flow to equity model like I use for your DCF, make sure you have another way to evaluate the debt separately from the valuation. Valuation is weird. The price of something is weird because it doesn't always take into account every risk factor, debt being one of those. But the free cash flow of the firm actually does because it looks at bondholders and stockholders. And so I'll let you cover that part because that's more in your wheelhouse.
Yeah. So as Andrew explained, there's basically two different kinds of models that you can use to value a company. And the one that I like to use is called free cash flow to the firm. And basically what that does is it measures the operations operational earnings of the business and then tries to determine an enterprise value of the company, which you can think of as the equity of the business and the cash that the company owns less the debt. And so that is the part where the debt actually comes into play, because that's how you're valuing the business. Because when you invest in the firm of the business, you're investing in the equity, which shareholders own, the cash, which the company owns, less the debt, which if we sold the business, the receivers wouldn't be responsible for. So the debt is excluded from the overall value of the business. So when you kind of just, generally go through a free cash flow to the firm model, you're looking at the operating earnings of the company less the taxes. And then and that's what's called NOPAT. And that's a proxy, if you will, for free cash flow. And then you go ahead and value the company based on the NOPAT or the free cash flow and reinvestments. And that gives you an enterprise value, which you add the cash on the balance sheet to, and then you remove the debt, and voila, you have a value of the company based on the total equity value or enterprise value that you think the company is worth, and then you can divide it by the shares outstanding, and voila, you got a price per share kind of thing. So that's kind of generally how it works. So debt definitely does have an impact in it. It just has a different impact at a different place. And so the more debt the company has, the smaller the enterprise value is going to be. And so that's where it really kind of impacts the company. And that's how it, I guess, encompasses the impact it has on the value of a business.
I would say, just my perception, it seems to me that private equity or companies that do M&A, especially, care a lot about enterprise value.
Yes.
Because if I was, if I'm Berkshire Hathaway and I want to buy Caterpillar, for example, I have to understand that if I'm doing that, I have to pay that debt off, right? Because they're acquiring the entire business. They have to pay the debt off in order to now own Caterpillar. Usually that's the way the debt is structured, right?
Right.
You contrast that to if I'm your average Joe, I'm buying stock in Caterpillar. If nobody buys Caterpillar, maybe they're just refinancing that debt, rolling it over a 10-year period. I don't really care about the debt as much because I'm not trying to acquire the entire business. I'm just an equity holder. So at the risk of oversimplifying, I'm not saying it doesn't matter. I'm just saying that that's why I think you tend to see more of a focus on enterprise value, especially with some of the smaller companies that could be acquisition targets. And you hear it in the M&A kind of. It'll be very interesting to me if we start to see more M&A moving forward, if that becomes a bigger and bigger focus.
Right.
It's so weird that metrics go in and out of favor, right?
Yeah, right.
Why is it like that?
Right. Yeah, it's true. Well, it just seems like the market goes through periods of a lot of enthusiasm for acquisitions or mergers. I think it depends on where we are in the market cycle and interest rates and all that stuff. And so those things all have a bearing on those ideas, of course, a lot. But there's periods where when you focus on a value of a business, maybe the debt doesn't equate to as much scrutiny, I guess is the best way of putting it. I think we've seen this in a very compressed period, obviously, but 2020, 2021, when interest rates were rock bottom, debt was through the roof. Debt to equity was not a thing. And then when the interest rates started to go up, then debt to equity became a thing. And so, it just kind of depends on, what people are buying and, what the noise is in the market. I mean, to me, I always look at those things, but I understand that it goes in and out of favor, if you will.
Yeah. Well, people crazy.
Yeah, right. Yeah, they can be. Sorry. All right. So let's move on to the last question. So what is a free cash flow ratio that allows you to compare between companies? So this is from the Twitter machine. So great question. How do you do this?
Well, actually, I feel like you made an infographic that answers this way better than I can. So do you mind talking through that infographic?
What I'll do is I'll just briefly tell everybody there's three metrics here. So I'll tell everybody what they are, and then you and I can kind of talk through them. So the first one is free cash flow margin. Second one is free cash flow yield. And then the last one is free cash flow conversion. So the first one, free cash flow margin, basically is we're taking the free cash flow that a company generates and we're comparing it to the overall revenue of the business. Again, the higher the number, the better. So pretty simple. It indicates efficiency of converting revenue to free cash flow. Free cash flow, for those who are unfamiliar with this term, is basically the lifeblood of every company. Without free cash flow, companies cannot reinvest. They can't grow. They can't pay us dividends. All those things are necessary. Think about free cash flow as like the money you have in your checking account. So the money that you air quote have left over at the end of the month, which we never do, that is the money that you can use to go out and spend it on things you want. So that's what free cash flow is. The next one is free cash flow yield. And basically what we're doing with that is we're trying to measure the return we would get on an investment if we bought it based on the free cash flow. And what it's doing is it's comparing free cash flow to the market cap of the company, which is basically taking the price that it's trading for in the market, multiplied by the shares outstanding, and that gives you the market cap. And so the higher the number. So if you find a company that's trading, like let's say Visa's trading at a 5% free cash flow yield, that's awesome. That's really good. So the lower the number, not so much. It just basically means that it's an inversion of the price to free cash flow. And so what it's telling you is that that's the return you should get. You would get to expect for buying $1 of free cash flow for Visa, for example. And then the final one is free cash flow conversion. And this is basically comparing the free cash flow the company generates to the net income or the earnings of the business. And again, the higher the number, that it just indicates efficiency, that they can take the earnings and create a lot of free cash flow for all the other things we talked about. So those are the three ones. So you want to talk about free cash flow margin and kind of what your thoughts are on that?
Yeah. So I would say in general, it should be close to a company's net margin or their net income margin, basically the basic profit margin. And I would say net income margin and free cash flow margin maybe get less attention than something like operating margin, but I would say for good reason, because net income can swing a lot from year to year. So can free cash flow can swing a lot from year to year. A retailer like Target or Dick's Sporting Goods, they might have a little, like years where there's just very little free cash flow because they're buying up inventory to ramp up for a lot of future demand, or they might have like too much cash flow where they've really pulled back their investing on inventory because they expect to slow down. So because they slow the reinvestments, they're getting all this cash from stuff they sold last year or 6 months ago. And so you really do see a lot of fluctuations depending on the type of company in the free cash flow. And so you will see fluctuations in the free cash flow margin and potentially the net income margin. So to me, if I was using that as a apples to apples comparison, try to remember what industry they're in, what type of business it is, and also that you're looking at a longer time frame to let those free cash flows smooth out rather than just taking 2024 or 2022. Try to put those in context.
Yep. That's great advice. And a good practice is to compare what the company has done. Like I like to look at a 1 year, a 3 year, a 5 year, and a 10 year, like rolling numbers to get averages to kind of see how they've done historically and more shorter term. The pandemic we're not that far removed from that. And some companies more than others could have been impacted by this particular situation way more than others. And so you have to take that into account. And I think so looking at shorter periods and longer periods can kind of help, as Andrew said, kind of smooth that out. Another really good practice would be not only to look at the companies that you're looking at, so let's say Caterpillar, but also to look at competitors in the same space and see how they line up. See how that other companies in their space, like Cummins, for example, take a look at Cummins' free cash flow margins over the same periods and see how they compare to Caterpillar's or other companies because that can give you a good benchmark of whether your company is doing well or not comparatively to others in the industry. And then the last thing that I would recommend you do is to look at Andrew mentioned looking at the net income margin and the free cash flow margin and kind of looking at what is really driving the free cash flow of the company. And the reason why I say that is there are a lot of, how can I say this nicely? There's a lot of zombie-ish companies that don't produce earnings or have negative earnings, but somehow they have positive free cash flow. Call me all fuddy-duddy, but it goes back to this, they're generating the free cash flow from things that aren't really cash. And so we can go into a big, long argument about this, if we wanted to, but really it comes down to, if you're paying your employees with stock, for example, that's not really cash. It's considered a non-cash expense, which means that it's money that they are supposed to set aside to give to the employees, but the way it works is it could be spent. And so they really owe that to the employees. So to me, that's a liability. It's an expense. It needs to be accounted for that way. So you will see companies, especially in like the SaaS space, that have negative earnings, very negative earnings, and then they're bragging about having positive free cash flow. And it's really all from something like stock-based compensation, or it could be depreciation because they bought a butt ton of, a big old bunch of, equipment, and they're, expensing it via depreciation, and that boosts their free cash flow. So it's not really, I don't think it's really cash flow. I mean, again, call me old fuddy-duddy, boomer, whatever you want to, however you want to put it. So that's something I always try to keep in mind.
Yeah, you are a boomer, and I am too, so it's okay.
So what are your thoughts on free cash flow margin? Or I'm sorry, yield.
When I was a beginner and I didn't really understand like free cash flow yield or earnings yield, understanding the dividend yield, and it's kind of the same thing, but just for free cash flow, that kind of clicked for me. So free cash flow yield can be a great shortcut for finding companies that might be cheap, or stocks that might be cheap, or a decent price. And so it's a good screening tool, I think.
Yep, I agree. If I'm going to look at a metric to give me a sense, like Andrew said, of whether it's cheap or expensive, something like free cash flow yield is something I would look at, probably more so than earnings yield. Earnings yield, for those unfamiliar, it's just the reverse of the PE ratio. Just like the free cash flow yield is inverse of the price to free cash flow, price to earnings, the earnings yield is they're just inverse of each other. So it equates to the same idea. And I think valuing companies based on the free cash flow is probably, I think, more reasonable than the earnings. And I think it's more consistent, and it probably gives you a better chance for a better return, because just simply for the fact that there can be some shenanigans that can go on with earnings, where with free cash flow, it's a lot harder for companies to manipulate. And so it just kind of removes that one layer of doubt, I guess.
What about free cash flow conversion?
This is a great one to kind of tell you how efficiently the company basically converts its earnings to free cash flow. And the better they do that, and this really kind of excluding the whole stock-based compensation brouhaha, this really comes down to how the company manages its net working capital is really the best way to think about this. And really what I'm talking about is the better a company can manage things like inventory, accounts receivable, accounts payable, will go a long ways to how well they manage their cash. And so think about it this way. When Walmart needs to buy more inventory, that means that there's cash going out of the cash flow statement. Same with accounts payable. So when they pay a vendor for that inventory, that comes out of accounts payable. And so the bigger it sounds like cheating, but it's not. It's the way businesses work. The longer the Walmart can get terms on buying that inventory, so if they buy jeans, for example, from a vendor, the longer they can get to between having to collect money from that inventory that they sell in the store to paying the vendor for the jeans that they bought, the better they can convert their earnings to cash flow and have more money available to go buy more inventory, for example. So without getting into all the gobbledygook of how that works, basically it just shows you how efficiently they can manage the money coming into the account and the money going out of the account to buy the things that they need to do to sell stuff. Microsoft, I feel like, is a better example, where they sometimes build things and sell them, but they don't actually collect the money for it until later. And so something like accounts receivable will kind of indicate that. And so again, how they manage the flow of creating things, selling things, and when they receive the money really goes a long ways too. And so the higher this number is, the better. You're looking for something over 1, ideally. Those are my thoughts.
Yep, for sure. I think it can be a good way to find. Some businesses just inherently have a better moat that allows them to be more efficient with their working capital. And that can be an advantage, to your point, like that can help them compound at a greater rate than maybe somebody who doesn't have those advantages.
Yep, exactly. Do you have any other ratios or anything else that you would kind of look at to think about how you measure free cash flow?
Like nice shortcut ones like this?
Yes or no?
I look at like the whole picture, the whole shebang. So no, I don't use any other shortcuts than this. How about you?
No, you could pull out a gazillion and one different ratios, but I think these three really I feel like they tell the best story to give you like kind of an overview, like a higher level overview, and maybe give you some questions to try to dig more into, like, like the working capital, cash flow part of the equation would be something that would be really good for people to dig into and really understand, is inventory growing compared to revenue and why, and just, understanding some of those more nuanced parts of the free cash flow statement. And I think that would go a long ways towards you having a better understanding of kind of the flow of money in and out of the business and how well management manages those. And I think that can give you a little more holistic view of a company like Google, for example. To me, that's the best way to do it. And then, digging in and using all of that for valuing a company via the free cash flow. All right, folks. Well, with that, I will go ahead and wrap up our conversation for today. I wanted to thank everybody for taking the time to send us those fantastic questions. Please keep them coming. Again, if you'd like to send us any questions, you can reach out to us at newsletter@einvestingforbeginners.com. That will be in the show notes. You can also send us questions on the Spotify app if you're listening to us on the show, which you should be. And then lastly, you can send them to us on socials, either X or the Twitter machine. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.